So let me know if you have any question in the chat. Okay, so today we want to talk about how taxes affect investment in Canada. One of the most expensive things we pay in Canada is taxes. It is not that house, it is not the rent. I promise you. The most expensive thing we pay in Canada is taxes. You have to pay taxes, I have to pay taxes, everybody needs to pay taxes. So if we know that we must pay taxes, but there are some investments that are tax free, why wouldn't you set up TFSA and you have savings accounts? I don't get it. So let me explain why. A savings account is taxable in Canada. Your money that you put inside that savings account is not what is taxed, but the return. If you invested 5,000 and the return is $100, that $100 is taxable. That $100 is taxable. Now, the question is, have you maxed out your TFSA? If you have not maxed out your TFSA, you might also need to consider that. You might also need to consider setting it up because tax-free savings account offers tax-free benefits to you. It offers tax-free benefits to you. But so there is something that is called T5. T5 with your savings account, once the money you have in your savings account has accumulated, right, you end up paying a lot of taxes there. Okay, you end up paying a lot of taxes on your returns on that savings account. But if you have your tax-free savings account, it is not taxed. It is not taxed. So the question is, do you want to pay more taxes than necessary, or you want to pay just the required taxes, or you just like to do for that Christmas and Mother Christmas? If that is the case, then we understand that you want to give out money and we will voluntarily collect it from you. I'll be the number one on the list. So when it comes to investing, it is important that you understand how taxes affect your investment. There is one that is called tax-free savings account, TFSA. The reason it is called TFSA is because it is tax free. Now we have a normal savings account, but that savings account is the one that I have mentioned is taxable. Okay, the interest that you earn on a normal savings account is taxable, but what you have in your tax-free savings account is tax-free. There are some exceptions. If you do what you are not allowed to do on a tax-free savings account, then you are going to pay taxes. If you actually put in more than what you are allowed to put into a TFSA, you are going to pay taxes. If you are out of the country, you are even a citizen, but you moved from Canada, you went to another country, and then from that country, you are contributing into your TFSA. It makes your TFSA taxable. That makes your TFSA taxable. I hope that is something you know. So you can only contribute into your TFSA when you live inside Canada. Once you do not live in Canada, you become a non-resident, you are subject to taxes. Okay, I hope that is clear enough. So that is one thing you need to understand about TFSA. And if you do what is called day trading, you're monitoring the stocks, you buy, you sell, you buy, you sell, you buy, you sell, you buy, you sell, you buy, you sell. That is called day trading. That is not allowed in a TFSA. If you do that, CRA will look for your address and CRA will send you the tax bill. You are not allowed to do day trading inside your TFSA. Team Saka, how are you? What question do you have for me, please? Which question do you have for me, please? Can you put that in the chat? I would like to know, please. I would like to know the question you have for me. Okay, I see your request to join, or maybe you sent it by error. Okay, I believe you sent it by error. Okay, sounds good. Let me know if you have questions in the chat. So now, if you are looking to do what you need to do now before January, and you say, "Oh, I forgot," your tax deductible account is now your priority. So if you've never bought a house and you know that in the next 6 months, 1 year, 5 years, you know that you want to buy a house. So the money you want to save and invest for that purpose, you're supposed to put it in FHS, a first home savings account, and I can help you set it up. You know, as human beings, we like to say Where is the best place for me to get my food stuff? Where is the best place for me to get a high quality shoe, high quality bag? People say that a lot. Oh, where is the you just call someone, where is the best place to get a gown or a dress? I just want to buy high quality shoe. You know when to ask those questions. I'm going to ask you this. Where is the best place to set up your investment in Canada? Which financial institution is the best one in terms of investing? That question, I receive it almost every day. And my question will be like, see, we have different financial institutions in Canada. The one that you know is the one that you know. But because I'm a licensed professional and I work in this space, I'm able to tell you that we have different financial institutions. Some will give you 1%, 2%, some will give you 15%, 20%. But that means you understand the different options available. There is index funds, there is ETF, there is mutual funds, there is segregated funds. You can invest in different platforms. Now, the information that you have access to will determine if you have invested your money with a financial institution that will give you 1% or 2%, and that is your choice. If somebody told me this for I think it's like 5 years ago now, I cannot forget. The person asked me this question. Yeah, you see, if you send your child to a school and they are not teaching that child very well, and you can afford to take that child to another place, will you take that child to another better school? I said yes. He said, okay, if you are investing where your money is not generating good return, you are just supposed to take your money out of where it is and put it in a financial institution that can give you high return. I said that makes a lot of sense. So when it comes to investing, if your current financial institution does not give you good return, what do? You take it out and put it in another financial institution that can give you good return, right? So how will you marry your money to a financial institution where the return is 1% or 0%? Yes. So do you know, is swing trading and position trading. In Buza, you have to do that research by yourself. What I have mentioned here is day trading. Day trading is not allowed in TFSA. What that means is you buy a stock today, it jumps up, you buy a stock for $30, it increases to $50, you now sell it. Tomorrow morning you buy it at a much cheaper rate, you look for within 4 hours it has increase in price, you sell it again. So when you do buying and selling of your shares frequently like that on TFSA, CRA does not like that or like those things in a tax-free savings account. You know, TFSA, you can put money, take it out. So far, you have not maxed out your TFSA. So there are so many good problems. If you have maxed out your TFSA, you have filled it up to the total contribution room. If you take out money this year, 2025, 2026, excuse me, you can't put it back in 2026. You have to wait till 2027. But if you have a lot of space in your TFSA, fine, you can take money out, put it back, take money out, put it back, right? So that's some things that you have to take note when it comes to TFSA. So let me now explain the difference between RRSP and FHSA. Very, very important that you guys understand the difference between FHSA and RRSP. Both accounts, the money you put there, you can take it out to buy your first property. But the difference is that the money you put in, and both of them, so let me tell you the similarities actually. The amount of money you put into your FHSA and the money you put into your RRSP, you can declare it when you're filing taxes the following year. That is why both accounts are called tax deductible account. So it means if you put money into your first home savings account this year, or you put money into your RRSP this year, next year you can use it to file taxes. So that is why I'm reminding you about what you can do that can help to get tax reform, so that you don't say you were not told or you missed the opportunity to leverage on this tax refund account. Okay, so now the another similarity between both is that you put money into your into your first home savings account or your RRSP, that money should be invested. The money should not be sleeping. Okay. The third similarity is this. Both accounts can help you to get tax refund. That is why they are called tax deductible accounts. So I'm going to talk about the difference now. FHSA, the money you put inside your first home savings account, any money that you put there should be used to buy your first house. If life happens, you are you are concerned about the benefit of FHSA and you do not take note of this particular characteristic, the money you put there should be used to buy your first house. If life happens, you want to take out that money to do any other thing, you are going to be heavily taxed. So the money you put there should be used to buy your first home. That is what it is designed for. And if life happens, you change your mind, the money inside your FHSA, you don't want to use it to buy a first home, you want to take it out. If you don't want to pay taxes, you have to transfer it from your first home savings account into your RRSP. Okay. But if you are okay and you want to take it out for any other thing, then you are going to pay taxes. So that is why TFSA is good, because you have access to your money, no restriction, no tax. You can put money, invest for 2, 6 months, 1 year, in case you need money for emergency purposes. You can take it out without no tax consequences. So I am saying this now so that this is before we close our eyes and open it, is December. If you know you are looking to buy your first property in Canada, you can literally open the FHSA. The money you put there is to achieve that purpose. It is going to help you when you're going to file your taxes next year. It is going to help you when you're filing taxes next year, right? Now, the money you have in your FHSA, you can take it out, and also the money from your RRSP, you can take 60,000 out, put it together. Whether you have money in a savings account or TFSA, you want to pull money together to buy your first property, you can absolutely do that. Or inherited money, you can pull money together to buy your first property. But the issue is the money you take out from your FHSA, you don't need to put it back. So far you take out money from your FHSA to buy your first house, that account is already closed already. You can't reopen it. Okay. But the RRSP, the money you take out from your registered retirement savings plan, you must put it back. Can you see the difference between both accounts now? Money you take out from your FHSA, money you take out from your FHSA must be used to buy a house. And when you take out that money, you are not, so you can't put it back. You don't need to put it back. That's it. But for RRSP, you are allowed to take out money from your RRSP to buy your first home. So let's say you have RRSP from your employer, you are contributing, your employer is contributing, or you have a personal RRSP and then you want to buy your first home, you are allowed to take out 60,000 maximum. Even if you have 100,000 there, you can only take out the maximum 60,000. So if you have 20,000, 10,000 from your RRSP, you can take that out, add it together to your FHSA, buy that first property. But you see that RRSP, you need to understand the characteristic of RRSP. RRSP is for your retirement, so you are not supposed to touch that RRSP before retirement. You are not supposed to. I didn't say you cannot. You can, but there are tax consequences for every ignorance action. Right? If you take out money from your RRSP before retirement, you are subject to taxes, except you take out that money to buy your first house or you take out that money for school. So only two options exist to touch the money in your RRSP without taxes. Only two. The third option is that you are going to pay taxes. Okay. So when you touch the RRSP before retirement, you are going to pay either 10%, 20%, or 30%, whichever is applicable. And these things are things you can really just read within 5 minutes online on Canada, Government of Canada's website. So if you have your RRSP, it's a very good account, it's a tax deductible account, but you need to know this because I've seen people over the years of me practicing as a financial advisor, I've seen people make mistakes. Why? Because they went to a financial institution and the person was not patient enough to explain these things. Or maybe the person explained to them and they did not pay attention. All they were focused was just the juicy part of RRSP, right? The juicy part I have mentioned. But one thing I always stress to my clients, once you want to open RSP with me and you want to use my services, you like how I explain these things to you. My first thing that I tell you is you open this account, you put money there, we invest it in S&P 500. This money is for your retirement. It is not money you can say you want to take out anyhow. You want to buy slippers, you want to buy shoe, you want to buy Christmas clothes, you want to buy. If you do that, you are going to be paying taxes up and down like no man's business, right? So the money in that RSP is for your retirement, okay? Now I said you can withdraw. You are allowed to withdraw from your RSP to buy your first house or to go to school. Those are the two exceptions. Now, even though you are allowed to take money out to buy your first property and to go to school, the money you take out for both options, you must put it back. That is why I always make this statement about RRSP. You are not supposed to touch it. It is for your retirement. Yes, at retirement, in Buza, at retirement, yes, it is subject to taxes. Yes, correct. At retirement, it's subject to taxes. There are some school of thoughts that says, okay, invest in your RSP because at retirement the taxes is lower. It is true, but it's not true for everybody. Yes, if you're a high income earner, gradually you become higher income earner, higher income earner. By the time you retire, you have different sources of income. So your sources of income from different sources is called your world income. So at age 65, 75, if your world income is considered high, you are still going to pay high marginal taxes on your RRSP. So that statement, anytime I hear that statement, I always cringe that. Why are people just being generic? Because the advice, that statement is not true for everybody. Imbuza, I'll repeat it. Thank you for that good question. The benefit of RRSP is this: it is for your retirement. The money you put inside, let's say the money you put there this year, okay, you will declare it next year when you're filing taxes. It can help you get tax refund. I mean significant tax refund. So let's say this year you put in 10K into your RSP. Next year when you're filing, especially if you're a high income earner, 120, 130 and above, it will help you reduce your tax burden. So if you put in like 10,000, 20,000 in your RRSP this year, next year you it might just help you not to pay taxes. I hope that is explanatory enough. That is the benefit. I hope I answered your question, Ngoza. And nice to see you this evening. It's been a while. Happy New Year. Charlene, nice to see you. Pima, how are you? Zenith, Oceano Stitches, Fombe, Michael, how are you all doing? Thank you for joining. Please like and share. Ngoza, I hope I answered your question. What about TFSA? Hope you can withdraw some and credit later. Yes and no. You can withdraw from TFSA anytime except you have maxed it out. Okay, so for me to be able to answer that question specifically, Oceano, please can you put it in the chat? Which year did you come to Canada? Because I want to explain specifically. So the answer to your question is yes, you can withdraw from your RRSP at any time and then put it back. That one is allowed. But if you have maxed out your TFSA, so what I mean max out is every year there is a maximum we are allowed to put into TFSA. So let's say for example, you came to Canada 2023 and for whatever reason you've been busy with immigration, busy with school, you did not open TFSA 2023, 2024, then 2025 you now decided to open your TFSA. Okay, so all the contribution room you had for 2022, 2023, 2024, you are able to put it out inside. So you have filled up the contribution room for 2023, you have filled up contribution room for 2024, 2025, 2026. You have been able to put all that money. So your TFSA, the contribution room is maxed out. If you take out money this year, you can only put it back next year. You can't put it back this year because you have filled it up. That is the only exception. But if you are someone that you came into Canada 2023 and in 2023 the contribution room was 6,500. Okay, in 2024 it was 7,000. 2025 another 7,000. 2026 another 7,000. So 7,000 times 3 years, which is 21 plus 65. It means if you came to Canada 2023, the total amount of money that you are able to put into your TFSA tax free and invest it in S&P 500, your money plus your dividends, your interest is not taxed, is 27,500. So if you are someone that in a position you put everything inside and you've invested for like 1 or 2 years and your return is maybe whatever return you have, right? And you say, okay, I need this money urgently. You can take it out this year, but you can't put it back this year. You have to wait till next year. So that's why I said yes and no. But if you're someone that you have a lot of space, you are able, CRE allows you to put 27,500 because you came to Canada 2023 and you only have 5,000 there. Fine. You can take the money out, put it back this same year, 2026. Can you see that there is no short answer to some of these questions that I received? Okay. 2019. Okay, amazing. Imbuza, your 40,000, what is the question? If you're a low income earner for RRSP, then what is the advantage? It depends. If you want to open RRSP, fine. But before you open RRSP, I will advise you to open TFSA for a low income earner because you might need the money. And if you have put that money into RRSP and you want to take it out, you are going to pay taxes. So from your small money, you are still paying taxes, right? So I would advise you to have both. Yes, have both. Invest in your TFSA, invest S&P 500, generate 10 to 15%. You have access to that if you need money for emergency situations. And then for your RSP, you can also open that. I hope I answered your question, please. Okay, so for Oceano, I'm going to answer your question now. You said you came in 2019. Okay. It seems the priority, yes, the priority should be TFSA for a low income earner. Yes, absolutely correct. Absolutely correct. Yes. I just did not, you have mentioned it, but I didn't want to mention it. So thank you for helping me. Thank you. Do we have any other questions? Yes. Charlene, thank you so much. God bless you. Imbuza, TFSA should be your priority. Invest in ETFs, invest in index funds, invest your money. Okay. So for my guy, Oceano, I'm going to answer your question by sharing my screen. Um, it is good for high income and I promise you. So look at it. If you came to Canada 2019, the amount of money that was allowed in 2019 is 6,000. 6,000 2019, 6,000 2020, 6,000 2021, 6,000 2021, 6,000 2022. So this is not my website. So you already see the website. So then for 2023 is 6,500. 2024, 2025, 2026, 7,000 each. So we are going to add all of those figures together. So 2019, okay. So 2019, 6,000. Okay. 2020, 6,000. 2021, 6,000. 2022, 6,000. So that is 6,000 in four places. So we have $24,000. Okay. For 2023 to 2026, it is 27,500. So, um, Oceano. So in your own case, the total amount you're allowed to put into your TFSA, the total amount of money that you are allowed to put into your TFSA since 2029 to since 2019 till December 31st, 2026, the total amount of money you're able to put into your TFSA is 00178 and invest it tax free. I hope I answered your question now. If you have questions, feel free to send in your feel free to send in your request to join the TikTok live. So yes, if you know you're looking to buy a house, that money should be in an FHSA because of the tax benefits, and that is why FHSA is called a tax deductible account. So feel free to send me a DM with your questions if you are too shy for TikTok live, or you use the link in my bio to book a one-on-one to discuss. I hope this helps.